Hi, welcome to Search for Yields, the weekly newsletter from INR Bonds. I'm Arjun Patsati, and in this week we talk about creating a fixed income portfolio in uncertain market environment. And clearly, the current market environment is highly uncertain for fixed income investors who are already been struggling with very low returns, but uh, with uncertainty along with low returns, where does one go and what is the best portfolio that can optimize returns over a period of time? Now, the market environment is clearly highly uncertain. You have the current ongoing Russia-Ukraine crisis, which is taking up oil and commodity prices, which will definitely lead to inflation expectations going forward. And inflation is already high globally. Inflation in many countries are at multi-decade highs, and look to be structural in nature rather than transitory, as central banks have thought. And the Fed is clearly way behind where inflation is. They are starting baby steps towards raising rates in March, despite the fact that the current crisis in the Russia-Ukraine crisis is growing on and it could affect growth. But they have no choice given that we are way behind inflation, which could lead to further instability as we go along. In India, you have again a very high government borrowing coming up next year, which is already hampering bond market appetite for government bonds. And with government bond yields rising, GSEC yields rising, then investors are a little wary of where interest rates can head. And in all this, RBI is not doing anything, and rates are still low for fixed income investors. So, how does one create a good portfolio for a fixed income? A good fixed income portfolio to tide over the current market crisis and also grasp the opportunities which will arise as this crisis eases. So the first step is always to identify the risk in the current market and how that risk can affect an individual's risk appetite. So if extreme risk in the market, high volatility across all equity and bonds, then an individual whose savings are very largely in fixed income and equities will be definitely be affected. And the quick and typically the first reaction is to stay extremely safe so that they don't have to see daily volatility in their portfolios. But there are many individuals who look at this volatility uh, as an opportunity as well and look to invest into this volatility to grasp the opportunity. So clearly the market risk is there. What do you need to identify? That's is the individual risk and how it's going to affect. The market risk is going to affect the individual's risk appetite. So to give you an example, if interest rates are going to rise and if equity prices are falling, then an investor invested in equities and also in longer term investments will see volatility in both the portfolios, including the fixed income portfolio, when they may not like it because they believe fixed income is more of a stable kind of a portfolio, which can stabilize a portfolio in times of equity market volatility. So in this case, clearly the portfolio should comprise of high safety, very short-term instruments where risk is very low, and even if returns are low, it is fine. But there are also individuals who would like a fixed income portfolio, but would want a better return profile, and would also maybe look to build a longer term portfolio despite market volatility. And in this such cases, maybe a good strategy would be a kind of a ladder portfolio where an investor invests in bonds of varying maturities in varying yields and then keeps reinvesting up the ladder as bonds mature. INR bonds has been a pioneer on bond ladder investing with many of our videos and research put out on ladder investing. You can check out our YouTube and previous editions of SFY for using bond ladders as a strategy. Um, Then clearly in uncertain market, you need to study what are the options available in fixed income investments. So clearly you have the markets, you have government bonds, you have state development loans, you have uh, treasury bills, money market securities like commercial CPs and CDs. You have uh, instruments like rates and InvITs, corporate bonds. Then you have also uh, products by mutual fund, fixed income mutual fund schemes who invest in all these instruments. So these are the options available. Then you have government run small savings schemes and obviously the fixed deposits. So all these are the options. And so within these options, what would be the best option to, or what would be the best portfolio to create given these options? So do you create a portfolio with a mix of fixed income funds, ETFs, or InvITs and rates and corporate bonds? Or do you create a portfolio with only corporate bonds or with only government bonds or SDLs? You create a short-term portfolio. What are the maturities you want to look at? Only 1 year, if that means only money market instruments, or up to 3 years or over 3 years. So all these are various options available to you, and you need to pick and choose the options to that where you go to the portfolio, and you weight it accordingly and get in the investment. So to make the portfolio, you have to think of three considerations. Obviously, the first is risk, the second is return, and the third is liquidity. And how liquid is your portfolio? When you need the liquidity, and if you need quick liquidity, or do you need to borrow money to come back sooner than later, then different kinds of portfolios you can construct. And the last would be, no, like I was saying, create the portfolio to minimize risk uh, and with the ability to grasp future opportunities. So if if the current risk is minimized and the returns can still be a bit commensurate with the expected returns that one individual require given the risk, then the if that is that is able to be if that portfolio can achieve that, then the portfolio itself can help the investor to grasp future opportunities. So if interest rates rise in the future, and typically when interest rates rise sharply, you also find times it's a good time to invest in long duration products, etc., where because some points of time the rates will typically fall. You might have to wait, but many investors who are in the wrong portfolios lose the appetite to invest in the correct products and or in the correct securities or bonds, and then they struggle to take advantage of the fresh opportunities that are available. So always the portfolio should be viewed with how to minimize current risk and also maximize the opportunities that could be available down the line. And so that if you can achieve that trade-off, then it's the best portfolio just possible. So INR Bonds is welcoming, helping advisors, financial advisors, and mutual fund distributors to create fixed income portfolios for their clients, especially in uncertain market times. Please contact us and also download our app, QuickInvest by INR Bonds, which will give the best bonds available to invest in such uncertain market conditions. And all you need to do is download the app, and then it will take you through this seamless information in the investment process with the most information that you can get in their uh, system today. Thank you very much for listening in to Search for Ease.